We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Hello, everyone. Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. We've gone through a bit of a rebrand, and we hope you like the new look. Our goal is to keep bringing you valuable content and keep you up to date on the important trends developing in the space. Check out our new website at palisadesradio.ca. Let us know what you think of the new look and video format. And as always, I'm happy to hear from each and every one of you at tom@palisadesradio.ca. Now, on to the show. Joining me today is Andy Schectman, President of Miles Franklin Precious Metals Dealer. How are you today, Andy?
Tom, good to see you. Good to be back. I'm well. I hope you're doing well as well.
Excellent to have you back. So as we're speaking today on Tuesday, the 10th of November, yesterday on the 9th, we saw gold just get absolutely hammered. So I want to get your thoughts on what happened there yesterday, please.
Yeah, absolutely, Tom. It's a drive-by shooting, and it was meant 100% to create a perception of reality. Get this, 212,850 Comex contracts were dumped on the silver market yesterday, and that was done to crash the market below its 50-day moving average. That is over 1 billion ounces of silver that was dumped onto the market to create a perception of reality. The commercial banks are running scared, Tom, and quite frankly, I don't know that I've ever seen that kind of a dumping on the marketplace all at once to create a narrative, to push it down below the 50-day moving average. And when that happens, you get the algorithmic black box fund programs that continue to sell, and they immediately, when they see something drop below the 50-day moving average, immediately dump their positions, which then just enables the snowball to gain steam as it moves down the hill. So here again, Tom, the yesterday was completely done 100% to affect or to create a narrative, to create an effect. It had nothing to do with physical demand. And as well, I'm sure we'll talk about here later on in the discussion, we did as many orders yesterday as we've probably done in the last week. So physical demand has nothing to do with what we just saw yesterday on the Comex. 212,850 silver Comex contracts at 5,000 ounces apiece were dumped on the market. That's not even including gold. This is all a drive-by shooting specifically done to create a perception of reality.
So is there any way to tell who dumped all those contracts on the market?
Who's got that kind of firepower? I'm sure it was the commercial banks. Just because JP Morgan was sitting on the sidelines doesn't mean their buddies weren't doing this. And this has all of the hallmarks of commercial bank drive-by shooting. Here again, if we look at what the others are doing, and I hope to talk to you about that here later in this discussion, the others on the Comex, I think they're standing there licking their chops, waiting to take physical possession of all of this stuff as they're standing for delivery. There is no one else other than commercial or central banks who has the ability to just dump 1 billion ounces of silver onto the Comex real close to the open. That was done specifically and 100% to create a perception of reality that fits the narrative of, everything should be okay now because we have a new vaccine. It's just bogus is what it is.
The timing was definitely interesting. And I was kind of laying there at 3:00 this morning, just sitting awake, thinking that the timing was just perfect, right after the election results. But since you were mentioning bullion sales yesterday, I wanted to ask you how sales have been for, let's say, all of 2020 as we're kind of coming into the last months here. And are you seeing any patterns that are surprising you?
Yeah, well, the first 6-7 months of the year was unlike anything I've ever seen. We 5x, 6x in terms of business from the year previous. I kind of described it as a great awakening in that people who had never thought about buying precious metals before were knocking down our doors. The mainstream had participated in ways that I'd never seen in the 30 years that I've owned this company. mainstream participation has grown rampant. I look at it somewhat as a two-part year, kind of like a hurricane. The first half of the year, the front edge of the storm knocked us all down. And living here in Minnesota, as I was saying to you offline, I call it the epicenter of stupidity, has been very eye-opening to me. I watched a city that I grew up very fond of and proud of. I don't recognize it anymore. It's a place that has been really beaten up on many levels. And, I think it's emblematic of what 2020 was in many respects to a lot of people here, more so than you can imagine. Just the entire aura of this town has been destroyed in many respects. And then came summer. And when summer came, everyone went outside, and hope springs eternal. And with that, there was a little bit of a quietness. Precious metals typically in the summer is quiet because normally in Europe, people are on vacation, people are outside, they're not looking at their computer screens. Especially in a northern climate. You live in Canada, I live in Minnesota, which should be Canada. It's pretty much the same thing. When the sun comes out, you realize, well, you don't have a ton of it. You might have 6 months of warm weather. You want to get out and enjoy it. So business slows down a little bit. And I have characterized what comes next as the trailing edge of the storm. And so when we see something like yesterday, where a vaccine is announced by Pfizer and the market crash, I look at it as, they must think we're stupid or something, because they smash down the price, which has no resemblance of physical demand in the industry. And they expect people to believe that. Quite frankly, our clients are smarter than that. They realize that it's a gift, that it's a subsidy, that nothing has changed, and more of the same thing. But in general, I will simply say that this year we've seen more business from a whole different subsection of people, mostly financial advisors, wealthy people who have known nothing but equities, who are now looking to precious metals. And it's a vastly different market than I've ever seen. And I do think, even though it hasn't shown itself yet, I think the trailing edge of the storm is still coming. And I think we will see a stock market, as an example, that is in my opinion, on shaky ground. If indeed this election is not continually contested and Biden takes over, you have an administration that wants higher taxes, that wants higher capital gains taxes and corporate taxes, taxes on transfer of stocks. That's not market friendly. And I think that we will see a market that sputters, if nothing else, maybe even craters. And so people, I think, have realized that there are very few asset classes any longer that offer any value, certainly not the bond market. And the stock market is as overvalued as it's ever been, with half the country unemployed. So there is an awakening, Tom. There's an awakening into precious metals by the mainstream. And so these smash downs, which typically would have had greater effect, have had little effect in our business. If anything, people flock and run to it, looking for value. And so I don't think we've seen anything yet. I think this is still a story that has yet to be finished. I think it's still a scary time in this country. And so precious metals, to me, are not an investment. They're wealth. And I think people are realizing that, hey, look, precious metals have outlived 2 world wars, German hyperinflation, the Great Depression. They're looking to it to protect their wealth. I don't think they're looking at it to get wealthy any longer.
Yeah, it was interesting yesterday. I know, watching the metals, they got smashed, and then there were certain mining stocks that started to dip, and then there were others that just went crazy. But it was interesting to watch all of those different plays. But as you're talking about, a Democratic president being elected, being possibly bad for the economy simply because of, or the markets, because of taxes and stuff like that, Democratic presidencies typically good for the markets simply because they do spend a lot of money into the economy and try to stimulate?
Yeah, well, stimulate, that's the thing. More stimulus, negative real interest rates, that's Keynesian economics. So I don't think that you build prosperity through spending. I think you build prosperity through letting the market, the free market, determine interest rates, and you build prosperity through savings, investment, and reinvestment, not through spending, taxation of the wealth producers, and spending money into existence to stimulate the economy. So to me, that's the opposite. That's continuing the narrative of spending to hold up a mountain of debt. So I think if the Democrats really wanted to get the economy rolling, and I don't think that there's anyone there that has the nerve to do this. In fact, you can go back and see the last politician was Paul Volcker, who really had the nerve to do something that was more or less crazy. He raised interest rates to 17 or 18% to slow down inflation. And now they want the opposite of that. If they really want inflation, if they really want to speed things up and get the economy rolling, I say they come in and make real interest rates or nominal interest rates -2 or 3%. This -0.2%, that they may move to, or controlling the yield curve, or where we are right now at 0.6 or 0.7% on the 10-year Treasury. When you factor in inflation, we are negative. But here's the thing. For the people who have enough money, they don't care. They want the safety. If you really want people to if you really want this economy to be stimulated, go to -2 or 3% interest rates and watch what happens. Mm-hmm. Now you'll get people buying anything, spending anything to stimulate not the economy, but to keep them from losing tremendous amounts of money to negative interest rates. So I don't know. The bottom line, Tom, is I think that you don't spend yourself into prosperity. If that were the case, you would have seen a Weimar Republic or Argentina or any of these countries that have destroyed their currency through spending. The wealthy countries, or certainly a whole lot better than the story ended up being for them. So no, I don't in this case think that spending and stimulus is the key. In fact, I think it's kind of like a drug addict. Someone who is coming off of a high, you give them another dose of drugs, they may feel better for a little bit, but it doesn't change anything. And I think that's what we're at right now. The stimulus is just more of the same and doesn't change any of the fundamentals. Just for a little bit, it may make people feel better, may make the economy feel better, but it doesn't change anything. In fact, if anything, it probably makes us worse off.
Absolutely, Andy. One of the other questions I wanted to ask you, in doing some research for today, I came across something very interesting. I thought that you were saying about the risk of storing bullion, let's say in other jurisdictions right now. Typically we see that from people that want to protect their wealth and their bullion. Let's say from repatriation or making it illegal to own gold. But you had a very interesting perspective on that.
Yeah, well, I think what you're referring to is my comments about storing it in Singapore. Look, we have a very vibrant storage program in Canada. We have worldwide exclusives with Brinks, whereby we are the only company in North America that charges a fixed rate structure. We have worldwide exclusives, or North American exclusives rather, on our safe deposit box program in Canada with Brinks. There are a lot of things I like about storing metal offshore. Our company was founded on Swiss investments. I spent 3 summers in Zurich in the 90s when I started in this industry, learning about Swiss investments and spending time with Swiss bankers, and used to be very fond of recommending people store their metal in Switzerland until FATCA came around and the Swiss kicked everyone out. Viamet no longer took American citizens, nor did Credit Suisse or Union Bank. All of the big companies that once were said no to the U.S. And I had to kind of reassess the situation as it pertains to storing it in a place like Singapore, which is friendly for gold and gold investment. You have to also think about the the second part of your investment, and that's bringing it home or liquidating it. Liquidating it in Singapore is not a problem. Bringing it home can be. Now, there may be programs out there that you're familiar with that make it a little bit easier to bring it home. But in general, my experience has been if you want to send your metal home from Singapore, it is incredibly costly. It is incredibly difficult. More often than not, it makes sense in that respect to sell it in Singapore and repurchase it wherever you are. Well, that may work now, but it doesn't always work. So I think liquidity and flexibility is very, very important. While I agree, as Doug Casey says, keeping your money in a different country than you reside is a good idea. And having the privacy and the anonymity to do so with no reporting, like our Canadian program, is only icing on the cake. For our American investors, under normal circumstances, you can get across the border pretty darn easily. You can drive across the border. But trying to get your metal 5,000 miles away across the Atlantic Ocean, especially in the midst of a pandemic, is certainly not easy. And I think that needs to be factored in to the equation. How easy is it to get your hands on it if you need it? I think the very nature of precious metals is that it is there for an opportunity or an emergency. And so it's one thing to have it in another country. It's another thing to have it in another country, and it's very difficult to get access to. And to me, that would be the one drawback for people in North America storing in Singapore is repatriation of the physical metal itself. It's costly and it's not easy. So that to me is the biggest drawback of keeping it in Singapore. And for our North American listeners, the biggest advantage to storing in Canada. Look, where you are, you're surrounded by 3 oceans. You're a resource-rich country. You don't aggravate the rest of the world. You have a banking sector that was voted the best in the world several years running, surpassing Switzerland. I watched the Royal Bank of Canada sell their branches here in the United States. Maybe, just maybe, they want to stand on their own 2 feet. I don't know. But in a world of imperfect choices, I learned very quickly that even the best plans need to be reevaluated when Switzerland kicked all of our clients out. And so I think that you have to find a middle ground between a place or a jurisdiction that is friendly to your investment strategies and needs, but also one that allows you the ability to quickly and efficiently repatriate it. And that's the thing that I think is a little bit more difficult when you talk about storing things across the Atlantic Ocean.
So as we're talking about, trying to preserve our wealth by having, let's say, physical gold and silver, let's talk a little bit about the little man rule. So what is it, and where did you come to learn about it?
So when I was a financial advisor a million years ago, I was always taken back by the little man rule. In fact, it was when you would get your Series 7, which was an exam that allows you to become a stockbroker, you take a class. Typically, it's a week-long class, and they give you a book. It's about this thick. And when you open up page 1 of the book, I was blown away by this. Now, again, I had started Miles Franklin in 1989, and when I was a financial advisor, it was 6-7 years after that. There were some reasons why I wanted to do that. So I already had a perception of things different than most of the people in the class that I was surrounded by. So when I opened up the book and saw page 1, it only reinforced my belief on many, many levels. Page 1 in a manual that is as mainstream as it gets says the little man rule. And that was the only thing printed on this page. And it said, the little man never wins. He always is late. He always follows after the trend has been established by the insiders, by the big money. And so this is kind of a very important topic. I've embraced the teachings of The Art of War. It's a book that I think everyone should really read and understand. It's a book written in the 5th century by a Chinese military strategist named Sun. The entire premise of the book is misdirection and beating your opponent without throwing a punch. So yesterday was a prime example. That's as misdirection as it gets. Misdirect the public through price. Smash down the price. Even though the fundamentals don't justify it, most people don't look under the hood. It's the no-look pass in basketball. It's the fake handoff to the right where and everyone moves to the right, but that one running back is wide open. It's misdirection in every game that you've ever played, whether it be checkers or chess or football or baseball or hockey. Any game surrounds or employs misdirection to confuse the opponent. And the same thing is true in the concepts that were taught in the art of war. It's taught in every major business school in the world on corporate hierarchy. It's taught in every major law school across the globe on formulating arguments. Bill Belichick uses it to formulate game strategy in football. It's mandatory reading it at West Point, mandatory reading at the CIA. The point of it is that misdirection is a pervasive concept. It's taught to the elite and to military strategists and to CIA employees and students at West Point. Misdirection is something people need to understand. And that is exactly what we see happening. The little man is misdirected always through price, and the public is misdirected through price. So they smash the crap out of the price of gold, even though the fundamentals don't support that. Yet that price smash is very, very it's noticed, and it affects a lot of people, and people then are misdirected away from where they should be. And this is something that is a concept that if you really look at things that happen in finance this way, don't just look at price. In fact, price is the greatest tool of misdirection, Tom. You got to look under the hood, and people don't have the patience or the time to look under the hood. So the little man rule fits exactly into what we saw yesterday. The little man is too much affected by this type of misdirection when people who are listening to you are not, and they realize it's misdirection, and they use it as a subsidy. They use it as a gift. And that's the way that I see it, because until things under the hood change, the price is just noise. It is just misdirection. It is just a opportunity or a subsidy to get more ounces in an environment that would tell you that that's a darn good thing. And this noise about a vaccine certainly should not merit a $100 sell-off in gold. It's just counterintuitive on every level. But to the people who only look at price, makes good sense to them. But that's classic misdirection. That's classic little man rule. And I think we'll see more and more of that. So, I mean, the only way to win that is to have strong fingertips, to trust your gut, to see the mathematics of it all and the truth of it all, and do not look at price, especially a drive-by shooting smash down in price that has little reflection to what's happening to reality, and look at it as a subsidy. And as you opened up this conversation, it is a gift. And I think that's the way you need to look at it.
Yeah. So as you're saying, really the misdirection of let's call it the smart money or the big players in this space. Let's talk a little bit about the others group on the Comex pulling massive amounts of metals off the exchange. So who are they, and what significance might that have?
I think it's one of the biggest things to talk about. I think it's one of the biggest things that I've seen in a long time, and really fits into the 2020 narrative. So normally when we would look at the Comex market, you normally look at it through two subsets of traders. You look at it through the commercial banks versus the speculators, like the mutual funds. Typically it's or the hedge funds rather. So typically it's the commercials on one end and the specs on the other. In this industry, or on the Comex, very, very, very few contracts stand for delivery. Typically 1 or 2%, small amount, whatever it is, it's a very small amount. It's used for hedging, whether it be a farmer trying to hedge his future production on a commodity crop that he's planting, to remove the uncertainty of what the growing season will be. He'll forward sell production. Or our precious metals company will hedge their inventory exposure. So if we have 1,000 ounces of gold in our warehouse, we'll sell 1,000 ounces on paper, so we are market neutral. But in all of those examples, the farmer's not standing for delivery. We're not standing for delivery. Most of the people who employ Comex strategy are doing it to hedge risk. They're not doing it to take delivery. So this year, something very interesting has happened. And I think I'm going to answer that question by taking a quick step back and putting it in line with a couple of other things. And I don't mean to ignore the question because I'm going to come back to it. But let's go back just a couple of years first to 2017. And in 2017, we saw the German Bundesbank say, we want all our gold. We're going to take it back from the Bank of England and the New York Fed. And something very interesting that they said, Tom, was that, hey, 2020 is a hard, fast deadline for us, period. We want all this stuff in our hands by 2020. You can Google it. You'll find that they did use 2020 as a hard, fast deadline. Shortly thereafter, you had the Bank of Austria, the Bank of Hungary, the Bank of Poland. They all did the same thing. You had the Dutch National Bank brought their gold home. And along the way, they said gold is something to the extent as gold is what is used to build from a destructed system. They had some statement that you can find that also. And they publicly said that it is the foundation from which broken systems reemerge. It gives credibility. So you got all the Central, Eastern, and Western European central banks bringing their gold home from the Bank of England and the New York Fed. That's constant number one. So we'll use that as a theme here. Big money taking their gold home and removing counterparty risk. Of course, as you and I have talked about before, in 2019, you had the reclassification of gold as a tier 1 asset by the central banks, meaning it's a riskless asset. That was probably the biggest event of my career. So first you have all the banks bringing their gold home, and then you have the banks reclassifying it as a tier 1 asset. And then we look at what happened this year. So we have the rise of the others. The others is the third category on Comex. It is typically going to be, they're very private. We don't know exactly who they are. You can't point fingers at it, but they would be sovereign wealth funds, family offices, and the wealthiest people in the world who typically trade on the Globex market, which is reserved for very wealthy people. There's tons of anonymity in it. The bottom line is simply this. These others, these very, very plugged in wealthy people are doing the exact same thing that the most sophisticated, well-funded, well-informed investors in the world are, the central banks, and that is bringing their gold home, taking possession of it by 2020. And what they are doing is standing for delivery. You see, the way a lot of these commercial banks have been able to suppress price, like we saw yesterday, is they would naked short. They drive the price down. Even though they don't have the metal, they had the money to create a narrative, to create a perception of reality. By driving the price down with keep on selling short until the pain is so substantial that the funds have to sell. And so then all of those positions that the funds put on that were purchased from the commercial banks expire worthless. The commercial banks keep the premium. The funds lick their wounds and they rinse, wash, and repeat. They let the price rise. They suck in the speculators and they smash the hell out of it. The speculators run, they collect the premium, the speculators lick their wounds, and they continue to do this. But this year, something different has happened. These others, the sovereign wealth funds, the family offices, the billionaires, they're like, okay, go ahead and make it short. We're standing for delivery, period. Don't care how low you drop it, we want delivery. And what we are seeing by these others is more metal taken off the exchange in a month than we typically see in a year. So, and this is on every delivery month. Now, there is a massive open interest into December by these others. Massive. Are they going to bleed the Comex dry? Will we see a force majeure? I don't know. Will we see a cash settlement? I don't know. But look at the narrative. You have the most well-funded, well-informed, influential traders on the globe reclassifying gold as a tier 1 asset, bringing their metal home from the marketplace, the London Metals Exchange, the Bank of England. And now you see the others, the sovereign wealth funds, family offices, and the super plugged in wealthy people standing for delivery to take their metal off the exchange. The common thread in all of this is removal of counterparty risk. It is taking possession of metal in a rigged game. And I think when we go back to the little man rule, here again, the insiders are pulling their shit off the exchange.
And this is a really important point, right, Andy, is that, you always kind of want to pay attention to what the insiders and the quote unquote smart money is doing and use that as instructive of what is coming and where the ball is going to be, right?
Well, that's exactly it. And the thing of it is that the insiders leave crumbs. So, take a poll, Tom, talk to people that ask them how many people know what a tier one asset is or that gold is reclassified. Ask them how many people know that the European central banks are repatriating their funds. Ask them about any of this. How about the fact that the International Monetary Fund 2 weeks ago called for a new Bretton Woods? How about the fact that the World Monetary Organization has a new meeting in May of this coming year, 2021. You know what the title of that is? The Great Reset. How the hell did they know this? That they were going to call it the Great Reset, and that it's not even for another 8 months, 10 months. Point of it is the insiders are telling us what they're doing, but the smashing of the price is all that the people see. That's the misdirection. Misdirect by smashing the crap out of the price, but forget about all the little crumbs that we've left along the way, showing you what we are doing. And then when the shit hits the fan and everyone realizes that they have all the gold, they say, well, we told you that we reclassified gold. The IMF told you, it's on their website, that they want a new Bretton Woods. I mean, all of these things, if you really dig, you can find. But the problem is that the information that most of the country or most of the world is getting is very biased. It comes from a handful of companies that control every piece of information out there. And that's been very troubling to me with this election. You can see half of the YouTube channels that I speak on, thank goodness yours didn't, were taken down because they had the audacity to mention Hunter Biden and his misgivings. So the point of it is that the information that we are given is slanted, it is biased, and you have to dig deeper to find what's really happening. And God bless guys like you that, not only have the courage, but the platform to get out there and let people say what's really happening and talk about what's really, really happening. Funny thing is, all that everyone sees is a smash down in price. And I don't look at that as anything other than a gift. Everything else that's happening around us is far more relevant. Like the most sophisticated players in the world bringing their metal home off the exchanges and home from the Bank of England and home from the New York Fed. Well, these are supposed to be trustworthy institutions. So what's the deal? Why bringing it home? Why take it off the Comex? I got an idea. One word, as far as Comex is concerned, rehypothecation. Rehypothecation means that every one of these guys who owns a contract that says it's good for a 100-ounce bar of gold, well, that's rehypothecated 300, 400, 500 times over. If everyone stands for delivery, in that example, 499 people get paper paid back or cash settled. One person gets his gold bar back. So that's the point, is that the insiders realize that it's a rigged game. The insiders know that if push comes to shove, if they are not the first ones out the door with their metal in hand, they won't get it. And so I think that's what I take away from all of this, is that the insiders are telling us, they are telegraphing what they're going to do. But all anyone sees is the price smash down. And you and I both know that there was no justification in it whatsoever. And I think that's why you started out this conversation by saying it's a gift. I agree. It's a subsidy, one that is not justified. Instead, look at the crumbs that are being left and that are being spread across the land, and you'll see that physical possession of precious metals has never been more important, ever. And I think the insiders are telling us that.
That's some very illuminating stuff there, Andy. So tell us a bit more about the IMF asking for a new Bretton Woods moment, and maybe give us some context about explaining what the first Bretton Woods agreement was.
Sure. In 1944, after World War II, the Allies met in Bretton Woods, New Hampshire, to anoint the dollar as world reserve, taking over from the British pound sterling. And so that it is a conglomerate of about 190 plus countries that they give funding to third world countries. They are a lot of people think that their mission is to make other countries indebted to them by lending them money to build their infrastructure. However nefarious their mission really is, it's 190 countries that was anointed as well alongside the U.S. dollar at Bretton Woods. It was formulated in 1944 at Bretton Woods, and the fact that they are now asking for a new Bretton Woods tells me that you have 190 plus countries who are saying we want a new system. I think that's really, really big news. That's huge news in context to gold being reclassified as a tier one asset. I think what they are basically saying is that the dollar's days are numbered. When you take a look at every world reserve currency since the 1400s, typically they have a 40 to 50 year time span. We left the gold standard in 1971. We are at the tail end or the end of our 50-year run as world reserve. The JP Morgan Private Wealth, the group of JP Morgan that works with the wealthiest people in the world, the centimillionaires and the billionaires, last spring sent out a letter to all their depositors. One of them is a client of mine. And he sent me a copy of the letter where it says, we want you to mitigate your exposure to the US dollar through foreign currencies and precious metals because we believe it will be challenged for singular world reserve status. So here you have the 190 countries who are basically telling you, in not so many words, that we believe that the dollar's end is near and we want a new Bretton Woods standard. It would be a new global reserve system is basically what they're saying. And so, here again, not many people know this. You can go to their website and read it. It's not reported. It should have been all over front page news. It should have been the lead story on the evening news that 190 countries from around the world that were formulated at the original Bretton Woods Agreement in 1944 are now asking for a new Bretton Woods Agreement, a new Bretton Woods moment. And so you're talking about anointing or crowning a new world reserve status. What that is still yet to be determined, but I think it is just another piece to the puzzle that things are changing rapidly. And if you take a step back and realize that a tier one asset is a riskless asset, and now that the governments are calling gold a tier one asset, I believe, along with them saying we want a new Bretton Woods, what you will see is a digital currency tied to gold. I really do believe that. I've been saying that since March. I think we will see a digital currency that has a gold tether to it. Maybe only 5 or 10%. It won't be convertible, but 5 or 10% of whatever the new Fed coin or whatever it is will have a pegging to gold to give it credibility. And the gold will be validated on a distributed ledger, at least in terms of its immutability. Now, who audits that gold is another story altogether. But the bottom line is, I think that the world, if they ever expect the world to drink that Kool-Aid again after what we have done to the US dollar and to its value, it has to have some sort of a pegging to gold. So my guess, that's why they that's why they reclassified it. That's why all of the central banks have used 2020 as a deadline to bring it home. That's why the IMF is calling for it. That's why the World Monetary Organization is saying this coming May, their meeting is called the Great Reset. Put it all together. They're bringing their gold home, all of them, by 2020. They're reclassifying it as a tier one asset. 190 countries say we want a new system. And now the World Monetary Organization says it's the Great Reset in May coming up. Put it all together. It's easy to see what's happening, that we're on the cusp of change. And so I think that we own gold and silver, Tom, because it's lived through 2 world wars, because it's lived through hyperinflation, because it's lived through the Great Depression and every pandemic and still has value. And now it's been levied to the highest valuation in the world, tier one status, a riskless asset by the central banks. So I think that the noise that is pushing the little man around is exactly the wrong place to be. They are being misdirected. They're being herded into the wrong place. And this is what I mean by trusting your gut. Don't look at what your eyes are telling you. Listen to your gut. Now, if you want to look at what your eyes are telling you, look what the big money is doing. Do the research. See the crumbs that they're leaving, and they're all over the place. The only thing of it is that unless you're digging and looking under the hood, you'll never see those crumbs.
Mm-hmm. So, Andy, let's talk a little bit more about these digital dollars. What would some of the advantages be for governments of going to a system like this, and should one maybe try and operate without them? I think will you even have the choice?
I don't know if you'll have the choice. It'll be a black market, like in India when they changed the currency a couple of years ago. You had just a few days to turn in your old rupees, or they were worthless. I think the real reason that you're hearing talk of a digital currency is, it's twofold. ultimately it's where they want to go. You can say, it removes the black market and blah, blah, blah. But I think the reason the Fed wants it right now has to do with inflation. So we can talk just a little bit about that. It's a common misconception that quantitative easing is inflationary. And in normal times it is. But right now it's deflationary. What I mean by that is simply this. Quantitative easing, let's talk about what that means. First of all, so when the primary banks that buy the bonds from the Fed, when they buy those bonds, they are also obligated to sell them back to the Fed if the Fed requests. And so that's quantitative easing. The Feds will buy the bonds from those banks like Goldman and Citi and JP. They'll buy those bonds, which decreases interest rates. It pushes interest rates down by buying the bonds in the secondary market, drives down interest rates. Those bonds now go on to the balance sheet of the Fed. So the Fed has two tools. They can lower interest rates and they can increase their balance sheet by buying things. And now that they've kind of melded with the Treasury and BlackRock, they're actually buying ETFs and junk bonds, and their assets, which they were never allowed to own, are now expanding, which levitates the equity market, levitates the bond market, and keeps interest rates low. But what it doesn't do is create inflation, because that money, which normally, which people would think would go to the banks, does not go to the banks. In fact, by pulling those bonds out of the market, you are sucking liquidity out of the market. The money then is deposited into the Federal Reserve in a reserve account for the banks. Now, the only way the Fed is saying to the banks, go have a party, go out and loan that stuff, go have a great time. It's crazy. Go buy stuff or lend it to people to buy stuff. Thing of it is that they don't want to do that. They're looking at the Fed and say, are you crazy? We're in the middle of a recession and I'm not making any loans right now. Instead, I'm just going to loan it back to you and you can pay me interest. I'll keep it in a reserve account because I'm not going to take that risk. After what happened last September with the repo market, our balance sheets are already destroyed. And then you take a look at all of the loans that we've made to companies across the globe who are either bankrupt, going bankrupt, or on the verge of completely being destroyed because of COVID. We're not making any loans. Hell no. And so what happens is that money sits in the Federal Reserve reserve accounts instead of being lent into existence. So you have to understand that money creation is about lending. In this country, it's lent into existence. If you're not making loans as a bank, or you're not lending to the public, or the people aren't borrowing, I mean, God forbid they're paying down their debt as it is and trying to, rein in their own spending. But if people aren't lending and the banks aren't making loans, then money creation or velocity is at the lowest level ever, as it is right now. No one is lending. Money is not being created. Yes, interest rates are low. Yes, asset prices are high, but the actual inflation is not happening. If the Fed gets their wish and we get this digital Fed currency, now they can sidestep the lending process and deposit money directly into people's accounts. That will create the inflation. That will create the velocity. You hear some people say, well, and maybe they'll even put a timestamp on it. So, for example, here we are in November, we got Christmas 6 weeks away, 8 weeks away. So let's do this. Everyone gets $5,000 in new Fed tokens in their wallet, and if it's not spent by Christmas Day, it disappears. Sounds kind of far-fetched, but if you're looking for inflation as a way to inflate away your debt, and you're not getting the central banks or the commercial banks lending, making loans, creating money, creating inflation, the workaround is to create a Fed wallet that goes directly to the public, usurps the lending process, and gives the Fed the ability to create wicked inflation. It also then allows them to see everything that's happening. The government can monitor every single transaction you're doing. If you're playing in a poker game with your buddies and at the end of the night everyone has to square up, well, they'll see that I paid you and you paid Johnny and Johnny paid Mike. Everything will be on a ledger. It is certainly I think the state would love it to know exactly where everyone is spending their money and how so. That's one end of it. But in reality, what I think they're trying to do is create inflation, because we have a debt that can never be paid off. We have a debt, when you count funded and unfunded liabilities, in excess of $100 trillion. It'll never be paid off. And so what do? You either inflate or you default. Most governments don't want to choose the path of default. They'll take the easier route of inflation. But if the banks aren't creating money, you have no inflation. So a digital Fed coin would certainly ignite that fuse of inflation. And I think really that's what they're looking for. The rest of it is just icing on the cake at this point.
So there's one more piece of the puzzle, Andy, that I'd like to talk about, and that was the Fed releasing two papers several weeks ago with the language of agencies finalize rule to reduce the impact of large bank failures, and the other one reads agencies issue final rule to strengthen resilience of large banks. So if the banks are trying to play it safe by tightening their lending standards, even though interest rates are low, why would they need to protect themselves like this?
Well, that's the point. That's why the banks don't want to lend. I mean, these banks, their balance sheets are in tatters. Go back to September of last year with the repo market problem. The banks don't trust each other. Here again, the word rehypothecation comes into play. They have assets on their balance sheets that supposedly have been rehypothecated many times over. If I'm Bank of America and Wells Fargo, and normally we trade with each other in the overnight lending mechanism, and I don't want to trade with you because I don't trust my own balance sheet, let alone yours. The bank's balance sheets are very fragile. All of the loans that they have made across the globe, many of which are destroyed, and it's only getting worse. All of the businesses that are gone forever. I don't know how 50% of all the small businesses in this country are gone forever. Those are loans that'll never be paid back. And many of the large corporations are zombie corporations hanging on by a thread. So I think what you have is a situation where banks are over leveraged and undercapitalized, and they have rehypothecated assets. So here again, they're leaving crumbs. The fact that about those two papers that were released by the Fed, I talked about it on one of my last interviews, but take a poll. No one else has read those. They're not in the paper. They're not talked about on CNBC. They're not talked about on Fox News. The public doesn't know this stuff. And that's really what I'm getting at, is that the insiders always leave crumbs. And this is the little man rule. The big man sees all of this information because they're the ones that are speaking it to themselves. The little man is watching Monday Night Football. The little man is not paying attention to something like that. So here you have the Federal Reserve saying that we're very concerned that the primary banks, the big commercial banks, are in big trouble, is in essence what they're saying. And we're taking steps to try to protect that from happening. But in reality, they're telling you that, look, you got a guy like Alistair McLeod who's been saying for months that a systemic banking crisis is coming, that the banks in Europe are far worse off than the banks here. But the thing is, they're all connected like a spider web. They're systemically connected. When you look at a derivative market of $2 quadrillion plus, if one goes, the rest of them go. It's like a house of cards. It's like a set of dominoes. So it should be very frightening for most people. The thing of it is that most people don't hear it. For a guy like you and I who research this stuff all day long, I hope it's frightening to you, because it is to me. Because if all of a sudden the banks start to go, then we're in real big trouble. And I think that when you see the Federal Reserve come out and say that, we should be concerned. And I think, quite frankly, Alistair has been calling for a banking crisis now since early summer. And the thing about economics and about making these kinds of statements, a guy like Alistair is using mathematics and economics to formulate his conclusion. And I do the same thing. And looking over the 30 years, one thing I've noticed is that we've been right every time. We're a mile away on the timing every time. These are high stake games, really high stake games where a lot's involved, a lot of money, a lot of lives. And so the timing is the hardest part to get, but the mathematics of it, the logic of it, the economics of it is all real. These things are going to happen. It's just a matter of how it all plays out and when. And that's why when we see a pullback like we did yesterday, it's a gift. It's a subsidy, because the fundamentals haven't changed for why we own precious metals and why we want to divest of dollars and why we want to pull our money maybe out of the banks, not have as large of an exposure in the banks, or have our metal held on the Comex market. Look at what the insiders are doing. If I were going to make one word to describe what the insiders are doing, it's repatriation. They're bringing their assets under their own control, taking possession of it, pulling it off of the exchange. And to me, that's exactly what people should be doing, is removing counterparty risk. Bottom line is, if you don't have it, you don't own it. And I think that is where we could quickly get. And here again, when we talk about the big banks and that same line of thought, in 08, how many people know that bail-ins have been written into law? How about money markets? People feel safe there. The same time they wrote bail-ins into law, they wrote gating requirement or gating legislation into law, which means you're gated. You ain't getting out. In 08, when the money market started to collapse, people were running out of the money markets. Well, now you can't. You're gated. You're blocked. Sorry, you got to stay because you can't let everything collapse. How many people know that? How many people feel safe in their money markets? Raise your hand out there. Do you know that it's gated? If the shit hits the fan, you're in with the rest of them, with the shit being dropped down on your head. That's the point, is that they are telling us what's happening quietly, little crumbs. But if you ain't paying attention, you're going to be herded with the rest of the sheep to slaughter. And I don't mean to be sensationalizing any of this, but it's very obvious that their actions are different than the words that they're saying.
Excellent, Andy. Well, I think that's all great information, and I think that's a great place to wrap up. Of course, we could find more about you and your company at Miles Franklin Co. on Twitter and milesfranklin.com, correct?
Yes, sir. That's right. And, Tom, I appreciate being on your show very much. I appreciate getting the opportunity to get the word out. If your listeners would send me an email at andy@milesfranklin.com and just put Palisades Gold Radio in the subject line, not only will I reply personally to every email, I will also make sure that your listeners are receiving the best price in the country and the best personal service. A couple things on that, and I'll wrap up. Number one, we are not an online company. The level of fraud in this industry is breathtaking. I have chosen to be old school. I close my online store. I choose to be analog in a digital world. I choose to really accentuate privacy. But we are very, very high up on the food chain. We're one of only 27 companies ever approved as an authorized reseller by the United States Mint. I can get anything anyone wants and get them the best price in the country. At the same time, our reputation, which we've never had customer complaints, we're, as I mentioned, a U.S. Authorized reseller for the U.S. Mint, and all of these accolades, never an A+ rating with the Better Business Bureau, all of this stuff we're super proud of. State of Minnesota, as I mentioned, is the only state in the United States where you have to be licensed and bonded. And so the majority of my peers in this industry have boycotted the state of Minnesota because of the legislation. It means that your listeners will not only receive the best price, my personal service and attention, but also licensing and bonding that makes a transaction safer than anywhere in the industry, bar none. So mention Palisades in the subject line, send me an email. I'll reply back with current inventory and answer any questions that people ask out of appreciation for you having me on the show.
Excellent, Andy. Thank you so much for that offer to our listeners and for your time today.
Absolutely. Thank you, Tom. Stay well. Hope to talk to you again soon.
You too. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.